Now, who else wish to record? Morning, everyone. I believe we stop here, right? Right. I believe we stop here, right? Hello. Right. So when we talk about 5C, we are talking about having the records, right? The records. It's about record retention. Right. Next case is Malcolm Young. Right. He writes numerous reports, right, rating companies in the luxury retail industry. Right. His reports are based on a variety of sources. Okay. So right. So a lot of sources, right? Now it didn't say whether he has done any record retention, right? I mean, the case just stops here, right? So basically, he must also keep records, right, during the research process. Right. So now we don't know whether he has kept records, right? So there's no answer here. So, I mean, right. So during the research process, he must carefully document and keep copies, right? So if he failed to do so, right, he would violate 5C. Okay. Right. Martin Blanks, right? He develops a model, right, while employed by GPIM, right? So while at the firm, he systematically documents, right, the assumptions that make up the model as well as his reasoning, right? So as the result of the success of his model, Blank is hired to be the head of the research department, of one of the competitors, right? So he takes copies of the records, right, supporting it. Right. So yeah, he can take the copies, right, provided he has obtained permission, express permission. Okay. Now, if GPIM doesn't allow him, right, he has to recreate the records. Right. So basically, the records are the firm's property, not the employee property. All right. Right. So has he violated? Yes. Right, because the records, right, are the records of the firm, right? So if he take the whatever documents, right, whatever records with him to the new employer without permission, right, he violates the standard. Okay, this is very easy. This standard is very clear cut. Right, so if he really wants to use the model, right, he must recreate the records. Okay, he's not supposed to take it. I mean, this is rather difficult, yeah, but then the key point is, okay, he must have permission, right? Because the records belong to the old firm. All right, that's a key point. Any question? Any question? Right, if there's no questions, we will talk about the last lecture. Right, so we have done completed standard 5. Right, last lecture. Right, there are still 3 students who are not here. Right, we'll talk about conflict of interest. This is the last standard. Right, this lecture. Disclosure of conflicts, priority of transactions, and referral fees. Right, so pay attention. Pay attention to the gist of the standard. Right, so the requirement of 6A, right, you must make full and fair disclosure, right? Full and fair disclosure, right, of all matters that could reasonably be expected, all right, to impair, your independence and objectivity or interfere with your respective duties to your clients, prospective clients, and your employer. Right, so it's about keeping your independence and objectivity intact. Okay, that's why you need to make full and fair disclosure. Okay, so this is the gist of 6A. Right, the second point about 6A is that when you disclose, right, you must make sure that such disclosure are prominent, right, delivered in plain language, right, and communicate the relevant information effectively. That means the other party really understood what you're saying about your disclosure. All right, so it's about clear communication. Okay, now, so these are the 3 standards and the cases. Right, so disclosure of conflicts, right? You have to disclose to your employer, disclosure to clients as well. Okay, so this is to both sides, right? And also, you have to, this is not about disclosure, right? This is about taking care of cross-departmental conflicts. Okay, so there's some issues here regarding cross-departmental conflicts, right? And conflicts with the stock ownership. Right, because the shareholders, right? These are the shareholders, right? These are not the management, right? So their interests, right? The shareholder interest and the board of director interest will be quite different. So there'll be some conflicts here. And conflicts as a director. Okay, we'll talk about that. Right. Right. In a lot of cases, right, the individual or the organization, right, will be involved in multiple interests. Right, you have a primary interest, right, and you may have a secondary or tertiary interest, right, but your objective is to look after the primary interest. Okay, the secondary or tertiary interest or the other interest, right, could corrupt the motivation. All right, because of these multiple interests. Right, so this arises, right, when you have conflicting interest, right? So this set of circumstances create a risk that professional judgment or actions, right, right, regarding a primary interest may be unduly influenced by a secondary interest or tertiary interest or whatever, right, by other interests. Okay, so this primary interest is likely to be your professional duty, right? Your secondary interest will be probably your personal interest, right? So primary, basically you're talking about protection of your client interest, right? And when you look after your clients, right, you're talking about at the same time the integrity of your research and the duties of your office, right? So this will be your primary interest collectively, right? Your secondary interest here, right, will be things like financial gain for yourself, you know, your own personal desire for professional advancement, or probably you wish to do favors for your family and friends, right? So these are examples of secondary interest. So what is the best practice to do, right? You try to avoid it as much as possible, right? Or the appearance of conflicts, okay? So if you cannot avoid it, right, cannot be reasonably avoided, right, you need to make clear and complete disclosure, right, of the existence. I mean, here the existence, that means the existence of conflicts of interest, right? So if only after you disclose, right, then both parties, right, the employers and the clients, right, will have the information, right, to judge, whether the investment advice or action taken on your behalf is objective. All right. Now I talk about directorship conflict of interest. Right. So as you can see, right, directors, right, they owe firstly, right, to a duty to the shareholders, which is above them, right, and the clients below them. So they are caught in the middle. All right. So you may have conflict of interest here. Right. So if you are given share options, right, as a director, that means you are also like a shareholder, and also you're a director, right? And if you're given share options, right, that means you're also a shareholder, right? So that means you have conflict of interest here. Okay. All right, I hope you understand this point. Right, and then there's this point here: opportunity to receive material non-public information, right, which could be divulged to directors related firms, right, possibly of insider trading. Now, you may be a director of company A, right, but you could be also a director of company B, C, and D. All right. Okay, so you could divulge the information to your other related firms, and your related firms will take advantage of this material non-public information, right, to commit insider trading. Okay, this is what the point here. Right. So again here, right, you can see in your job as an analyst, right, plus broker or dealer, right. Right. So you have instances whereby the sell side analyst may be encouraged to write research reports about particular, because of peer pressure. And the buy side may be coerced by banks, who exercise underwriting and security dealing powers. Okay, so if you don't work with the bank, if you don't say do them a favor, right, they could, maybe not cooperate with you, when you do any underwriting, or any securities dealing, right? They, you know, they can sort of betray you. All right, and the marketing division, right? So this is say within the firm, right? So marketing division may ask an analyst, right, to recommend the stock of a certain company, right? Because this marketing division may want to obtain business from that company, right? So you see the conflict of interest here, right? So this is between the marketing division and the analyst division. Okay, conflict of interest. Analysts may want to do an independent job, but the marketing division may try to twist the arm, right? Okay, so that hopefully you write a good report so that the marketing division will get more sales. All right. And now personal ownership of stock, right? So now if you can see the point here, right? You should refrain from owning any such securities recommended to clients or that clients hold, right? So if you hold the same stock as clients, right, obviously you your judgment, right, will be influenced, okay, so you'll be skewed in a way. All right. Right, so if you're an analyst, right, on the sales side and you also own some stocks, right, you should also disclose any materially beneficial ownership interest in that security or other investment that you're recommending. Okay. Right, because when you disclose, right, you try, I mean, this is a requirement of this standard, right? If you disclose, that means people can judge whether you are subjective or objective or impartial. All right. Right, so whether you're sell side or buy side, right, you should also disclose your procedure. So the buy side should disclose a procedure for reporting requirements for personal transactions. Okay, so this is to uh, also avoid accusations of being impartial. Right, now disclosure of conflicts to employers, right? Right, so you also should also disclose, right, any conflict of interest to employer, right? Provide employer enough information to assess potential. So you let your employer assess the potential impact of the conflict of interest. Okay. Right. So employers also should take steps, right, to also restrict personal trading. Okay. You as an analyst, right, restrict your personal trading, right, outside board membership, because you may divulge your information, right? So here we are talking about your position as a director in a firm. So if you have outside board membership, right, you could probably divulge material non-public information to your other companies, right? So this is the danger, right? And other related activities to prevent situations that might not normally be considered problematic from a conflict of interest point of view, but that could give the appearance of conflict of interest. So basically, you should also avoid the appearance of a conflict of interest. Okay, so that is why disclosure is very important. It's also to avoid the appearance of any conflict of interest. Okay, so okay, now let's look at some of the recommended procedures for compliance. Right, you should disclose, right, any special compensation arrangements with the employer, right? This is stated in other standards, right? That might conflict with the client interests, such as bonuses, right? So this is already covered, right? So there's some interconnection here, with other standards. Okay, this point here you have come across, right? So if the firm does not permit such disclosure, okay, so the member should document the request and may consider dissociating from the activity. All right, here basically you should show that you have already made the request, right? At least you've done your part to make the request, but the firm does not permit such disclosure. All right, so if you want to really adhere to this standard, right, you may consider dissociating from the activity, okay, to avoid any conflict of interest, appearance or otherwise. Right, another point is you should include information on compensation packages in the firm's promotional literature. Right, so if you're transparent about your compensation, right, so your clients can judge whether you're really independent or what, you know. So if the firm is based on a share of, if the fee, right, is based on a share of capital gains or capital appreciation, right, this information should be disclosed to clients, so clients would know how much you're actually getting, your compensation. All right. The other point, this point here, right, if there are any outstanding agent options to buy stock, right, as part of the compensation package for corporate finance activities, okay, the amount and expiration date of this option should be disclosed as a footnote to any research report published by the firm. Okay, right, so now these are options. It doesn't mean that you will buy, but you are given the option. So if you are given the option, that means again, this is a potential gain on your part, right? So the details, right, regarding amount, expiration date of these options, right, should be disclosed, right? So you have to be transparent again, right? Even though you may not stand to gain from these options, right? Right, now let's look at some case studies on 6A. Right, Hunter Wise is a research analyst with Farmington Company. Just hang on for a sec. Yes, Alfred. Yeah, yeah. Given to you. Given to you already. Yes. Okay, okay. Okay, thank you. Bye. Right, sorry for the interruption. Right, Hunter Wise, right, is a research analyst, right, with Farmington Company, a broker and investment banking firm. Farmington's merger and acquisition department has represented Wimco, right, a conglomerate, in all of its acquisitions for 20 years. From time to time, Farmington officers sit on the board of directors of various Wimco subsidiaries. Okay, and Wise is writing a research report on Wimco. Right, so you can see the conflict of interest here. Right, so now, I mean, this is the funny part, right? Right, Farmington, you're doing the M&A, right? Mergers and acquisition, right? And Wimco is your client. And the officers are sitting on the boards of Wimco. How can you do that? Right, it's a very clear-cut conflict of interest. Right, you're supposed to be independent, right? And you're also sitting on the board, right? This is a very clear-cut conflict of interest. Now, so when you write a research report of Wimco, definitely you're biased. Okay. Right. So now, so basically, WISE, right, should disclose in the research report, you know, because Wimco, Farmington and Wimco, right, have a special relationship in the sense that the officers sit on the board of Wimco, of many Wimco subsidiaries, right? So this relationship must be disclosed, right? So if you don't disclose, right, the key the you know, your independence and objectivity has been compromised. That's the key issue. All right. So conflict of interest and business relationship, has it violated? Yes, right. So basically, right, so WISE must disclose in the research report because of this special relationship with Wimco, right? Farmington and Wimco, right? Because of this broker dealer management of and participation in public offering must be disclosed in the research report. All right. So they have been doing it for 20 years, right? Okay. So they have been doing it for 20 years, right? So that's why the independence and objectivity may be compromised. So, right, 20 years, right, is a very long time, right? So they could have a very good relationship, right? So this relationship must be disclosed, right? Okay. Second case, right? Conflict of interest and business stock ownership. Right, the investment management firm of Dover and Rowe sells a 25% interest in its partnership to a multinational bank holding company. Okay, First of New York. All right. Well, this is supposed to be a multinational bank, right? And you're we are talking about the holding company, not the subsidiary. All right. So immediately thereafter, Margaret Hobbs, president of Dover and Rowe, changes a recommendation of First of New York's first common stock from sell to buy. Right. So right. So this is done after uh, Dover and Rowe sells a 25% interest to this bank. Right. So that means they have some relationship here. All right. So she changes the recommendation from sell to buy and adds First of New York's commercial paper. Right. So this commercial paper is another security, right, to Dover and Rowe's approved list for purchase. Right. So obviously here, there's, because of this sale of this 25% interest, right, the objectivity and independence has been compromised. Okay, you can see here, the action here, right? So this relationship, right, between Dover and Rowe and First of New York must be disclosed, you know, uh, must be disclosed. I mean, to all Dover and Rowe clients. Okay. So is Hobbs in violation? Yes, right. Because, right, so as I said, Hobbs must disclose, right, the new relationship because of this 25% interest, right? So this new relationship has compromised everything, right? So it must be disclosed, right? When they do anything, right? When they make recommendations or take any investment actions with respect to First of New York securities, right? So there's this commercial paper, right, which I've talked about. All right. Any question? Next case, Carl Fragment, right, a research analyst who follows firms producing office equipment, has been recommending purchase of Kincaid Printing because of its innovative new line of copiers. After his initial report on the company, Fragment's wife inherits from a distant relative 3 million of Kincaid stock. Right, he's been asked to write a follow-up report on Kincaid. Now his wife, right, received this 3 million, right, is as good as himself receiving the 3 million, right? So Fragment should disclose his wife ownership, right? Suddenly she became owner, right, of this 3 million Kincaid stock. So, right, so Fragment, right, should disclose to the employer. Right, so that again, that's also a best practice, right? Since his wife already owns some stock, right? He should assign this assignment, right, to another analyst, by right. So I mean, to give the appearance of not to give the appearance of being compromised. Okay. So is Farman in violation? Yes, right, because of his wife's ownership, right? Right, and so there's 2 points here, right? You must disclose, right? And also, well, there's also a best practice, right? This best practice is to avoid the appearance of conflict of interest. So he should ask his employer to assign another analyst to draft the follow-up report, right? To avoid the appearance of conflict of interest, this point here. If you have any problem understanding me, please ask questions. Case 4, Betty Roberts is speculating in penny stocks, right? Penny stocks, cheap stocks, usually under $1, right? For her own account, and purchases 100,000 shares of Drew Mining for 30 cents a share. All right, she intends to sell these shares at the sign of any substantial upward price movement of the stock. A week later, her employer asks her to write a report on penny stocks in the mining industry to be published in 2 weeks. Okay. Even without owning the Drew stock, Robert would recommend it in a report as a buy. Right, a surge of the price of the stock to the $2 range is likely to result once the report is issued. Right, so now she buys 100,000 shares for 30 cents a share. That means the investment here is 30,000. Right, $30,000. Relatively speaking, may not be a lot. Right, even though it's not a lot, right? Roberts should disclose this ownership, right? Because she owns these shares, right? She would tend to write a favorable report, right? So whether the price go up because of a report or not is irrelevant, right? So now the fact that she buys these shares, right, adds to the appearance that she's not entirely objective, right? Because she already owned these shares, right? Appearance wise, right, it shows that she's not objective. So now the rise in the price may not be because of her report, right? But other people may think that it is, right? Okay, so you get the point. Again, right? So this is conflict of interest and personal stock ownership, because of personal stock ownership. So has she violated? Yes, right? Right, as I said, 30,000, right, may not be substantial, right? But this is not the case, right? So whether it is material or not material, right, she must disclose in the report. right? Because of this reason, right, the gain for her will be substantial if the market responds strongly to her recommendation. Right now, her recommendation would have some influence on the market because she's an analyst. All right. Right. So the fact that she had only recently purchased a stock adds to the appearance that she's not entirely objective. This is the other point. Right. Case 5. Any questions so far? Right. Case 5, Samantha Dyson, portfolio managers for Thomas Investment Council, specializes in managing defined benefit pension plan accounts, all of which are in the accumulative phase and have long-term investment objective. Okay. A year ago, Dyson's employer, in an attempt to motivate and retain key investment professionals, introduced a bonus compensation system that rewards portfolio managers on the basis of quarterly performance relative to their peers and certain benchmark indexes. Okay, Dyson changes her investment strategy and purchases several high beta stocks. These are high risk, right, for client portfolios in an attempt to improve short-term performance. Right, these purchases are seemingly contrary to the client IPS. Okay, now an officer of Griffin Corporation, one of Dyson's pension fund clients, asked why Griffin Corporation portfolio seems to be dominated by high beta stocks, right? That often appears among the most actively traded issues, right? No change in objective or strategy has been recommended by Dyson during the year. Right, so now you have the client's IPS. Right, according to the IPS, right, you're not supposed to invest in these high risk stocks, but she's doing it. Right, she's doing it, and also is actively traded. Right, is contrary and is also actively traded. Why actively traded? Because of the higher commission.